When we look at the 2023, I see something a little different, which is, we're getting probably close to the top of the Fed hiking cycle. And so I'm not as concerned about valuation compression going forward, at least after maybe, quarter one, 2023 or so. But I am concerned about corporate earnings going down because I think the economic deterioration is likely to continue. And so I think you could see better results out of things that don't have earnings, things like gold or Bitcoin. They don't have earnings, they're not valued based on their earnings, they're monetary assets. Whereas I think you could still see some weakness out of equities.
Renowned macro analyst and Bitcoin investor Lyn Alden has given her outlook on the world's largest crypto asset in 2023 and beyond. In a recent interview with Nico Moran, the host of Simply Bitcoin, Alden discusses the overall macro environment and its impact on Bitcoin prices. She explains that the crypto asset has always been more correlated with the business cycle. It performs better in rising PMI environments or periods of economic acceleration and remains flat or falls during periods of economic deceleration. Alden adds that the macro environment might remain somewhat gloomy and static through the next decade, but she believes there will be short bursts of relief. One such burst comes up in 2023, and according to Alden, it will be a great environment for Bitcoin and the entire cryptocurrency market. Bitcoin has had a rough week, especially with the increasing FUD around popular cryptocurrency exchange Binance. On Friday, news broke that Mazars Group, the accounting firm that was working on proof of reserves reports for Binance, Crypto.com, and KuCoin, had decided to temporarily halt all operations with all cryptocurrency firms. The news added to the existing FUD surrounding centralized exchanges and plunged the overall cryptocurrency economy below $800 billion. Top cryptocurrencies have also recorded new weekly lows, with the top altcoin falling to a low of $1,165 to begin the weekend. As of press time, it has recovered slightly and is now trading at $1,180, a 7.28% decline within the past week. Bitcoin has also recorded a 2.53% decline in the past week and is now exchanging hands at $16,723. The overall crypto market cap is around $808 billion, according to data from CoinMarketCap. Overall, these are not great numbers for the industry. Fortunately, Lyn Alden believes market conditions are about to become favorable for Bitcoin and other digital assets. We will now take you to Alden's interview with Simply Bitcoin. Please watch the video to the end, hit the like button, and subscribe to the channel for more videos like this. Thanks and enjoy the video.
To what's been happening. So we've not had, fast money supply growth this year. We're actually kind of flat to down for the year, which is unusual compared to the prior 2 years of rapid money supply growth. And so that puts a lot of pressure on all assets kind of equally. So bonds are down, stocks are down, kind of harder assets in general are down. And obviously, if you have leverage attached to them, you can be down more, which is kind of what we've seen in the Bitcoin crypto whole space, this whole kind of rehypothecation blowing up. You could see better results out of things that don't have earnings, things like gold or Bitcoin. They don't have earnings, they're not valued based on their earnings, they're monetary assets. Whereas I think you could still see some weakness out of equities. And so I think you could see more differentiation next year. But I try to avoid giving 1 year price predictions for an asset that's so volatile because, it's like part of answering that question is, well, what happens to Genesis? What happens to Grayscale? Is Binance fine? I think so, but maybe not. I don't know. And so you have to answer industry specific questions, often with opaque balance sheets and human decisions and things like that. But I think that historically, if you look at it, Bitcoin generally does well in rising PMI environments, so economic acceleration generally does flat to down in falling PMI environments, so economic deceleration. And it usually historically tends to bottom before PMI bottoms, and I think because liquidity tends to bottom before PMI bottoms. So actually, probably the closest overall correlation to Bitcoin price has historically been liquidity, and I think we're seeing maybe signs of that bottoming perhaps in the first half of 2023. But that's kind of just where we are right now. I mean, things can change in a month based on new information coming out. One is that I do think we're at the top of a local peak in inflation. The way I've been framing it, and this is before inflation rolled over, is that I think that just like the 70s and just like the 40s, that this is going to be an inflationary decade, but that doesn't mean you just constantly go straight up. You often have periods of disinflation, cyclical disinflation within a structural inflationary environment. And so usually it's because there's attempts at counterattacks, right? It could be Fed tightening, it could be price and wage controls. There's basically various kind of pushbacks that these top-down planners can kind of do against those forces that work for a period of time until something breaks and they have to change course. And so it actually, if anything, came about a quarter later than expected because starting at the end of 2021, I was predicting that around quarter two would probably be the peak in inflation. I think the Russian war added like a quarter to that. It kind of stirred things up a little bit more than the otherwise would have been, and so we got the peak in quarter three, and now we're rolling over. And I think as long as, it kind of comes down to how quickly China reopens. If they just tomorrow say, "Hey, we're going to go all out. We're going to completely reopen. We're going to give everyone, $1,000. We're going to promote like flights and travel and other fuel intensive things." You could get a major breakout in oil, for example. And that's obviously an extreme example that just shows how, some decisions can influence this. But essentially, I do think we're in a disinflationary environment, at least in the maybe first half of this year. I mean, next year, like 2023, maybe throughout the whole year. Where I would get concerned about another wave of inflation is maybe 2024, 2025. Next time when we kind of enter like another growth period, and that kind of goes back to the Fed. I do think if you got an inflation drop down to say 4%, I think you'd have more questions among Fed officials. I think some of the more dovish ones would be in favor of kind of loosening policy, especially if economic growth isn't very good or is an outright recession. Some of the hawks might still stick to it, though, because, for example, it seems to be the case that Powell has tied his legacy to his ability to get inflation back down. And so I think that he might be stickier than some of the others. But I certainly think that as it gets lower, that raises some questions. But it really comes down to what else is happening, right? So 4% inflation, if the economy is very strong, they can still justify raising rates more. On the other hand, if it's 4% inflation, but they're in a unmistakable recession, and they have like Congress breathing down their neck, and just rising problems, or if they have some sort of problem in the treasury market, due to illiquidity, then that's a different discussion. Then they might have to do some sort of a different approach, and kind of reinject liquidity into the market, despite the fact that inflation is above their target. I think that the overall end game, kind of later in this decade, is that they are going to be forced into a corner where there's inflation, and they're stuck adding liquidity to it. Basically to finance kind of, to monetize government deficits. So it could be in the form of yield curve control, deficit monetization, kind of, another round of QE, kind of like what we saw, I think, as a microcosm of what happened in the UK. So they had 10% inflation. They were talking about reducing their balance sheet. And then they had this awkward period for a few weeks where they had to, buy gilts. They had to buy UK sovereign bonds to bail out their pension system. And I think you could see rounds of that in the US. Maybe not right away, but I think that that will be something that happens, here in the 2020s.
Lyn Alden is not the only analyst predicting an inflationary decade ahead. Other analysts, including Raoul Pal and Gareth Soloway, have also shared similar opinions. Like Alden, both also believe we are heading for a moderate to severe recession in 2023 with a drop in inflation that could see the U.S. Federal Reserve and other central banks pull the brakes on quantitative tightening. In her interview, Alden speaks about a possible decoupling between Bitcoin and the equities market. She also discusses how Bitcoin's peer-to-peer transactions will make it harder for governments to tax individuals and how they might be forced to change their tax collection strategies.
Both in the 40s and the 70s, you had commodities do better than equities. Equities were kind of range bound, as you pointed out. In the 70s, in large part, that was because, if you had interest rates that are double digits, that goes back to my prior point where what is the fair value of an equity? If you can get 10% on treasuries, you probably have to price the equity in such a way that you can get 15% or more returns, which means paying a very low multiple. And so you basically had, nominal growth from inflation of earnings and things like that, but then it was offset by valuation reductions. And so you got this big flat, choppy pattern. In the 40s, it was different because, due to how high debt was, government debt, the Federal Reserve did yield curve control. So they kept interest rates low despite the fact that inflation was high, and yet you still had equities be very range bound. Now, obviously, there's other factors. Investors had to price in like the probability of winning or losing the war, for example, and the market basically bottomed as soon as the United States started making major victories, like after the Battle of Midway, for example, when they really kind of turned the tide on Japan. And so there are other factors that always make these things complicated. But overall, if you have an environment with negative real yields, equities can still probably do okay. Whereas if you have high nominal yields and high real yield, that puts a lot of downward pressure on equities. So overall, my expectation is generally that we won't see great performance out of equities over the next decade. I think that the prior decade was this big gain. It was very disinflationary, which was very good for corporate profit margins. But I think now they're going to have higher structural wage pressures in many cases, and I think that's going to just challenge overall profit margins, and they're likely to face some degree of just valuation compression and kind of trend sideways, at least in real terms, right? So I mean, if inflation's bad enough, like if you look at an emerging market equity index, they'll generally be doing great in nominal terms, local currency terms, but they'll be doing sideways to down in dollar terms. And so I think you could see something like that in the U.S. where if you do kind of by the end of the decade have runaway inflation and some sort of Fed repression and yield curve control, you could get a nominal breakout in equities. But it wouldn't necessarily be a good breakout in real terms. So I think my higher conviction case is a long period of sideways chop, at least in real terms, and probably for a number of years in nominal terms as well.
Interesting.
And as for decoupling, yeah, I think so. Basically, inflationary decades are very good for commodities, basically things that are scarce. They don't have margins. So gold, oil, copper, silver, Bitcoin, things like that. Bitcoin, the challenge there is that it's still perceived as a risk-on asset in large part because it's just not well understood. It's not widely held, and it's often leveraged because of its upside potential, and so that creates downward explosions. Um, so I think it'll still probably be correlated to say the PMI cycle for quite a while, meaning it's generally going to do better in risk on conditions and worse in risk off conditions. Um, but I do think that it can, if equities go sideways for that decade, I do think that Bitcoin can keep grinding higher, even if it's still often correlated on a day-to-day basis, more often than not. The first question was kind of a long range approach. Like, let's say we make multiple assumptions. Bitcoin's very successful. Bitcoin becomes very widespread. Bitcoin becomes more private due to various layers and things like that that can do that. Then that presents a challenge to the government because it makes it harder to generate income from seniorage, and it also makes trouble determining what people's income is or what their wealth is and things like that. And you kind of have to go back to the 1800s or earlier, that kind of era, to see how they handled that kind of situation, because a lot of transactions were just private bearer asset transactions. You give someone a silver coin, you get your bread, right? Or even if you're just handling banknotes that are redeemable for those metals, and so that creates a problem, and that's why you didn't really see a lot of income taxes formalized back then. It's just the administrative overhead was complex, and the ability to hide things was very easy. And so instead you would put taxes on. You always had to put taxes on things that you have a very high degree of transparency into. And so that'd be things like property, right? Property is very transparent, physical property. You could also, tax big things at the point of entry. So, import taxes, export taxes. You can also tax retail establishments, basically businesses, that have a presence and um, they have formal accounting, and so it's easy to look into their books. You can tax certain things that like alcohol or tobacco or things like that. And so that's how governments used to get a lot of their tax revenue. But in this era of fiat banking and more transparency of incomes, you've had, now in most countries, the income tax is often the biggest line item where they get, and especially when you add income tax with, say, payroll taxes, all the different types of income taxes together that are tied to income. Usually it's the vast majority of taxation. And it is harder to maintain that if you had overall better privacy as a widespread usage. But I think that's something that we don't see this decade. I think that's something that if you look at the long arc of time, that's something that we have to consider. With the rise of just encryption and money, right? So if you have Bitcoin, and then especially if you have Lightning or just various ways to make that naturally more transparent, and if those are widely done, it just changes how the government has to get revenue just out of necessity.
Bitcoin and blockchain technology will probably remain the biggest challenge to the old, tired systems for a long time. The digital assets industry is revolutionizing the existing financial and economic systems at such a fast pace that it is almost impossible to believe. What do you think about Lyn Alden's outlook for Bitcoin, the stock market, and the entire macro environment? Please drop your comments and observations in the comments section below. Also, ensure you hit the like button, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.